Hi, this is Adam from Presswood. When clients have underfunded their pensions, maximising contributions in the run-up to retirement is often the only way to ensure that they can maintain their standard of living when they stop working. But this solution often creates a lot of headaches, such as how much carry forward is available? Could their employee contribute more? Would they be better off getting tax relief now and potentially having a lifetime allowance penalty later on? And what would their cash flow look like if more contributions were made? In our last video, we took a look at Phase 1 of Truth's new suite of pension planning tools, which helped answer these questions. Now I'll show you Phase 2, our pension contribution cash flow tool, which will make life even easier for advisors and bring live pension planning to client meetings. This is our new pension statement. Note this client is making no personal contributions and a £10,000 employer contribution to their pensions. They can make additional personal contributions of £87,000 or employer contributions of £140,000 in the current tax year. Now we can take this one step further. Simply select the pension contribution tool directly from the client's cash flow. Choose whether you'd like to model contributions to an existing pension or a new one. Select the years you'd like to pay in and whether this is paid by the client or their employer. In this case, I'm going to select an employer contribution. And whether you want to prevent a breach of the projected lifetime allowance. Click Calculate and the result will be shown instantly on the client's cash flow. The result is overlaid on the cash flow so clients can clearly see the benefit of a larger pension fund in retirement and the increased income it provides. If we make this a personal contribution, we can see whether the long-term benefits of accruing a larger pension fund outweigh the short-term costs. We can see here that they do, and the impact is immediately visible to the client. Looking back to the pension statement, we can now see that the client is maximising their pension contributions. We can also see that these contributions are automatically reduced when the client reaches the lifetime allowance. So far, we've chosen to be restricted by the lifetime allowance. There will be cases where clients might be better off getting tax relief on contributions now and paying lifetime allowance charges later. Returning to this client's current position, they're using 54% of their lifetime allowance. Let's see whether they'd be better or worse off if they used all of their annual allowance until retirement, then paid their lifetime allowance charge. Here, I'm opting to make maximum employer contributions to the client's existing pension, but I'm going to elect not to be restricted by the lifetime allowance. You can clearly see that the client will be better off claiming tax relief now than paying their lifetime allowance charge at retirement. Note Truth also warns you that the lifetime allowance has been breached. Returning to the pension statement, we can clearly see that the client is now exceeding the lifetime allowance, and the new cash flow that we're projecting incorporates a lifetime allowance charge of £18,000. By using the Overlay Charts tool, I can clearly show the result of my recommendation to the client and illustrate the benefits of my advice.